All right, I never thought I'd be drawing this parallel, but what do houses and cars have in common? Well, for one, it seems impossible to find any right now. And two, when something does pop on, it seems like there's a million buyers out there willing to pay more than asking price to get it. Hey, I'm Ryan Schramm, realtor, broker, and owner of Ryan Schramm Real Estate here in San Clemente. Thanks for tuning in. Here are some shocking stats that I read yesterday. There are roughly 59% less homes on the market than there was last year. And if you look at an average, a 3-year average from 2017 to 2019, there's 77% less homes on the market today. Here are the numbers. Active in San Clemente, we currently have 48 listings. For homes that are either active, under contract, or pending, meaning they're in escrow, we've only got 61 of those. Okay, so on top of the insanely scarce inventory problem, we've got a whole new dynamic that's coming into play. Interest rates. Interest rates are on the rise if you haven't heard. I know we've been talking about that and you probably hear some noise about that in the marketplace, but interest rate rises are happening now. Rising rates are happening now. What have we seen from December to January? A half a point, a half a percent. Rates have already risen. So this is something that we're watching really carefully, and it's trickling down to real life scenarios for my buyers today. We're making a couple of offers today, and buyers are starting to feel the difference in affordability. What does that all look like? The additional rise in the interest rate, that half a point that I mentioned from December to January, that's about $250 per month to a buyer who's getting a $900,000 loan. However, what I'm seeing is, even with that extra $250 a month, there are so few homes to choose from that buyers are willing to bite the bullet on that. They're willing to pay it. If you think about a 3.625% interest rate, that's still a phenomenal rate. And yes, even though it's going to cost an extra $250 a month, buyers are like, I don't know when I'm going to see another house like this. We got to bite the bullet. Okay, so when and if rates hit that 4% mark, that same $900,000 loan is going to cost an additional $487 per month. Now, I'm not sure if that is going to be the threshold or if it's going to be 4.25%. That's the threshold where a buyer is like, okay, I'm drawing a line in the sand. I'm no longer willing to push up $50,000 or $100,000 above the asking price on this house. I've got to draw a line in the sand. But at some point, and you can see where I'm going with this, whether it's $500 or $600 or $700 a month extra that a buyer is going to have to pay on their mortgage, it will make a difference in the overall rate of appreciation. Buyers simply aren't going to be able to continue to push property values on the next listing like they have been for the last 2 years. And it's at that point that I think we're going to start to see a more balanced appreciation curve, if you will. I think that we're going to see home values start to become a little bit more realistic. That 18% appreciation that we've seen in the last few years, that should slow down to something more reasonable. Still appreciation 7%. Some people are saying 10%. Some people are saying 5%. But you can see between 5 and 10%, that's not as smoking hot, as scalding hot, as crazy to keep up with as that 18%. All right, so if you want to keep tabs on this with me and stay up to the minute on what's happening in the housing market, check out this video playlist. And as always, subscribe to my channel so that you get alerted when I drop a new video. Thanks so much for checking this out. And if you have any questions, please, on selling or buying in Orange County, shoot me a text or give me a call. I'd love to hear from you. Take care.